Hi everyone, it's Lynn Norusis from the Focus on Nova team. I'm here with Ed Jones, CPA, right here in Fairfax, right off Hunter Mill Road. He's going to talk to us a little bit about some of the things people might forget when it comes to filling out their taxes, but then also give us some tips for home buyers and new home buyers as to what they can look forward to when filling out taxes this season.
Hi, I'm Ed Jones. I'm a CPA. Well, for the last 2 weeks of tax season, I spent the last 2 months doing a couple hundred returns. I'm a little tired. So let's tell you what we've learned about that and what, as a new home buyer or just a person who owns a home, you should be tracking. The first and most important thing we've learned, as you've been reading in the papers, is that everyone's withholdings are off this year. So if you owed when you did your taxes, you need to look at your pay stubs now and determine if you're going to owe again and if you need to adjust them. There are excellent tools online available for that with the IRS. I strongly recommend you look at it. You're going to end up in the same situation. Most people have ended up in the standard deduction now, which is $12,000 for single, $24,000 for married filing joint. But you can run into some strange situations where even if your itemized deductions are below $24,000, you should itemize anyways because of the deductions that you get to take for the state. So for instance, in Virginia, the standard deduction, if you take it for federal, you're forced to take it in Virginia. The standard deduction for Virginia is $3,000. So I have most of my clients who have between $20,000 to $24,000 of itemized deductions are forcing it to happen. At least I'm making them do it on the federal, paying a little bit more to the federal, but saving $1,000 in the state. So you've got to double check that. Virginia has done some fixes to try and help that, but there's still going to be a chance you need to do that for next year. When you own a home, you have deductions that are considered itemizable. What are those? Your mortgage interest, that could be deducted. Only the mortgage interest for the purchase of the home or the improvements of the home are deductible. If you have a home equity line that you use to take care of credit cards or other debt for whatever reason, that is no longer deductible as of 2018. Your real estate taxes are deductible. However, it's a limited deduction. Your real estate taxes plus your other property taxes plus your state income taxes that you paid in, you can only deduct up to $10,000 on your return. Now you still need to track it though, because on the state you might be able to deduct more of that. Plus you never know when they're going to change the rules on us again, because they like messing with us, is my view. But once again, last 2 weeks of tax season, so what do I know? The other thing you want to be tracking, quite often the federal government has available energy credits for improvements to houses that are energy efficient. They haven't yet passed that for last year, so I might be doing some amendments this summer. Thanks, IRS. But you still want to be tracking all those and seeing if those are available. In addition, whenever you own a home, any improvements you do, you should have a home file that you put all your improvements into, because if you ever decide to rent the house out, it's really important so we know how much to depreciate. In addition, when you sell the house years and years later, and it's massively appreciated in value, you can end up in a taxable situation which gets lowered by whatever you've done to improve the house over the years. Those are the main effects you want to pay attention to as a new home buyer or someone who owns a house that are house related. Of course, all the old rules still apply as well, which is you should be tracking your charity to make sure that you deduct it. Most of the miscellaneous expenses that we used to be able to take for when you pay for things for your day job or you're paying investment expenses are no longer deductible, unfortunately, but you should still track them all because they are deductible for some of the state pieces. So, happy last 2 weeks of tax season to all of you. I hope it's gone smoothly. And remember, if you were surprised on your taxes, you might be surprised again next year. Make sure you do some planning. Hope you all have a good day. My name is Ed Jones. I'm a CPA in Oakton, Virginia. And I'm looking forward to 2 weeks and a day away from now, even more than you are.